In this video, we're going to explore ways we can improve our own position before we go and approach a lender or a bank for a loan to finance an investment property. And we'll also have a look at some of the financing options we have available to us as property investors. Well, thank you for sparing some time to watch this video. My name's Tim. I'm a property investment advisor, a property investment educator, and a property investor. Now, what I'm not is a mortgage broker. I used to be for many years, but right now I'm not. So anything you see in this video, anything I explain is purely for educational purposes only, and you really need to sit down with a mortgage broker or a lender or a bank and discuss and act on their recommendations rather than what you see in this video. Okay, so as property investors, for most of us, we're going to require some sort of finance to purchase a property. So said another way, it's very, very unlikely that you're going to have enough cash to purchase property outright. So we will require finance to acquire property. Now, the beauty about property is that most lenders, the majority of lenders, see property as a low-risk asset. So they'll allow us to leverage quite highly into a property. And we often used to talk about the fact that you could go into a lender or a bank and say, I'd like to get a 90% loan to acquire this property. And usually if everything's stacked up, they'd say, okay, no problem. But if you went into the same lender and said, I want to get a loan to buy shares in your bank and I want to go to 90%, they're probably very likely to say no. So lenders see property as a very secure asset, and that's why, again, we as investors are able to leverage highly into property. When we approach a bank for finance, effectively what we're doing is asking that bank to do a joint venture with us. They're becoming our business partner. So if we look at their position, they're actually leveraging or exposed a lot more than we are as investors into that particular property. For example, even if we were to provide a 20% deposit, that's saying or meaning that the lender is exposed at 80%. So we need to keep in mind that lenders are in the business of selling money. They're not property investors. They don't want the property. So they're going to qualify us quite strictly, if you like. So what they want to make sure is if there's a very low chance that this will go pear-shaped, because the last thing they want to do is end up on 60 Minutes or some current affairs program because they're hurting all these poor investors, kicking them out of houses and calling in their loans. So we need to keep in mind again that we have to present ourselves in a way that we look favourable to the lender as a business partner. Now, as potential business partners, the lenders are going to want to suss us out. So they're going to look at reasons to say no, effectively. They want to make sure that we qualify as very, very sound business partners. So some of the areas of our money management that they'll look at, such things as how many credit cards do we have, are we making those repayments, the number of children or dependents that we have, what's our repayment history been like, have we got evidence of other loans that we've paid off and made good on repayments, what sort of assets do we have, what's the value of the assets we have for our age. So they're looking again as us as business people, what are our credentials, why would they say yes to us around coming on board and partnering up with us to acquire this property. Again, they don't want the property, so they want to make very, very sure that we can make those repayments and keep that property in our portfolio and not have to sell it, forced to sell it because we can't, because we've defaulted on loans, etc., because we can't afford to service the debt. So that's another area they look at. What's our income? Now, when they apply an interest rate to the loan, when they calculate whether or not we can service the debt, they'll use what they call a benchmark rate. So that's usually typically around 2.5% higher than the actual standard variable rate. So really what they're doing is making sure that we're really, really sound. So if interest rates were to go up, we can still make, as borrowers, we can still make those repayments. They'll look at the rental income. So when they include the rental income for assessing our ability to service the debt, they'll usually around typically anywhere from 70 to 80% of that rental income they'll use for servicing. So they really do make sure that we are going to go through with this deal and we're not going to leave them hanging with this property that they don't want. Now, back in the day, we would refer to it as the 4C. So the lender would be looking at us in 4 different ways, if you like. So firstly, character. They'd be looking again at our money management skills, history. They'd be also looking at capital. So what sort of funds do we have to put on the table to get involved in this deal? Is it only a small amount or a larger amount? Obviously, again, the more exposed they are, the more they're going to drill down and make sure that this is going to work out okay for them. Collateral, the type of property that we're going to put up as security. The lender doesn't like some types of property, so they're going to make sure that the type of property that we're looking to acquire suits their lending criteria. And then the other one is our capacity. So capacity to make repayments on the loan. So they were in the old days, we talk about the 4 Cs. Nowadays, in the lending environment that we're in, they're going to look a lot more closely at us and drill down a lot deeper to make sure, again, that we are suitable business partners. Now, when we look to source finance, we've got 2 options, really. First one being we can go straight to a particular bank. So you might be dealing with a particular bank now. You might just go in one of their branches and talk about acquiring finance through them. The other option we have is using a mortgage broker. Now, I would say here, again, totally up to you what you do, obviously, but I would say at least keep in mind the value and the extra leverage you might get from using a good, qualified, experienced mortgage broker. So analogy I can use, if you like, is that if you were looking to acquire a car and you went to, say, Ford, and you said, this is the type of vehicle I want for this particular purposes, et cetera, then they can only talk to you about their type of, or their Ford models. Even if they knew that down the road with another maker, another brand, they had a better option for you, they wouldn't tell you about that. Now, as far as lenders go, as far as banks go, if you go into Bank A, that person's only qualified. It can only legally tell you about their products. So again, even if they knew that there was a better product with another lender, they can't tell you about it, and they won't tell you about that. So the benefit of using a finance broker is that, particularly one that's experienced with property investment, is they understand the difference between lenders. Now, a bit of a rookie mistake is to think that all lenders are the same, because they're absolutely not. Some lenders are more favourable towards property investors than others, and make it a lot easier to acquire finance. Every lender has its little subtleties, if you like, so it's worth really considering at least sitting down with a good, qualified, experienced mortgage broker, putting your case forward, and then having them basically go out and research. If they don't already know, they'll look across different lenders. They'll put scenarios up to lenders without basically showing their cards, if you like, so they can come back to you then and say, based on what you've told me, these are the options we have available to us, and perhaps even recommend, look, if we go with this particular lender, we're able to do A, B, C, whereas these other lenders only allow us to do A and B, for example. So the message in this little section is that at least keep in mind and consider sitting down with a good, qualified, experienced mortgage broker, because it is critical not only to understand how various lenders work and what they're happy with, but also around getting the right finance structure in place. So particularly if you're looking to acquire multiple properties, it is highly critical to get the structure right, because leveraging into additional property can be complicated, and you really need to be set up the right way to be able to allow you to move forward and not sort of roadblock you with structures. I mean, they can be pulled down, but it is costly and time consuming. So to get it right the first time, sitting down with a lender or a mortgage broker, explaining what you look like right now and also what you want it to look like in the future will go a long way with making that process a lot easier and a lot more straightforward. Let's look at some of the options we have available to us when we're sourcing finance. And the first one we're going to cover is pre-approval. So effectively, pre-approval means that you've sat down with your lender, your bank, your mortgage broker, and effectively you've got the loan approved right up to the security point. So the only box that needs to be ticked is the security. So effectively, you've gone through that process and the lender has said, yes, we'll lend X amount to you. So you've ticked those boxes, and basically by doing that and going through that process, you'll put yourself ahead for about 2 weeks with someone who doesn't have pre-approval. So I guess as an example, if you and I made an offer on a property for the same amount of money and you had pre-approval and I didn't, very good chance the vendor would accept your offer over mine, because there's less likely that you are going to fall through or the deal's going to fall through. Whereas if they take my offer, then they've got to wait another 2 weeks and hope that I do tick those boxes for the lender, and they will then ultimately approve the loan. So with a pre-approval, again, it does give you an advantage. It may even give you an advantage to negotiate. So you could say, well, look, I don't want to pay the full price. I'm going to offer X, but I do have finance approved, and that may allow you then to move ahead and you have that offer accepted. So pre-approval, once again, is you've had everything approved up until the point that you found the security or you found that property. Once that happens, then there's a contract drawn up. The contract will go to the bank, and from there the bank will send out a valuer, and if the valuer and the lender are happy with the property, then effectively the loan gets approved and you move forward with the purchase. So that can be a really good advantage to have pre-approval. So you can chat to your mortgage broker or your lender, your bank, and discuss options around that, what that looks like for you as a borrower. Leveraging hire is another option that we generally have as investors. So effectively what that looks like is we can choose if the lender agrees to put in a small deposit size. So effectively what that does is preserves the capital that we have, and that may even allow us by doing that to acquire additional property. So we've spoken about loan-to-value ratios. So at an 80% loan-to-value ratio, that would mean that we're presenting or putting up a 20% deposit plus purchase costs. If we went to a 90% loan-to-value ratio, then we're going to halve the amount of money for that deposit. So on a $400,000 purchase, a 20% deposit is $80,000. If we went to a 90% loan-to-value ratio, then we're going to halve that, and that would require obviously $40,000 for that 10% deposit. So effectively, we've halved the amount of capital that we need to put on the table to acquire that property. So again, that'll allow us, or potentially allow us, to then leverage into additional property. Now, usually when the loan-to-value ratio exceeds 80%, there's a lender's mortgage insurance to be paid. So LMI is often referred to. Now, this, though, can be looked at as a cost of doing business. If we stuck to an 80% loan-to-value ratio, it may mean that we just don't have the capital to acquire that property. So by leveraging hire, again, it means we're going to put in less of our own funds. So it may be, as I say, a cost of doing business. Now, speak to your accountant and your finance person, but typically this fee is a one-off fee and it is tax deductible. So again, by paying that fee, it may allow us then to leverage hire and be able to acquire the property rather than having to wait to build up more capital. Now, the fee typically can vary from bank to bank. It typically varies on the loan amount, the loan size, and also the loan-to-value ratio. So the higher that loan-to-value ratio, typically the higher that fee will be. But again, it's an option there for us, and it may be the difference between acquiring property and not. Now, something else to consider is the type of payments or repayments we make on our investment debt. So typically, most investors will run with interest-only payments on their investment debt, particularly if they still have owner-occupied debt in place. So the focus would be to pay down the personal debt, owner-occupied debt first, and then look at considering paying down the investment debt. So another conversation you can have with your finance person, but that is typically what people will do, is run with interest-only payments on their investment debt, principal interest repayments on their personal debt. And this way also too, that will reduce, by having interest-only payments, that will reduce the outgoings or the costs associated with that, holding that investment property. So another consideration there is the type of loan repayments or payments we make as investors. Something else to be aware of is the importance of separating our owner-occupied debt from our investment debt. Now, particularly if we're going to claim the interest on the investment debt as a tax deduction, it's critical that we do have those two things separated. Now, back in the day when line of credits were born, people did get themselves into trouble. For example, they might have a line of credit facility where a portion of that was used to fund, say, the deposit of an investment property purchase. mixed in with the funds they use to acquire a boat, for example. So it's very important that we do keep those two things separated. Now, highly confident that the finance person you're dealing with will understand that. They have experience with dealing with property investors, and they'll understand the importance of that. And part of their training is to understand what that looks like as well. So it will also save us time and money when we go to work with our accountant at the end of the financial year by being able to produce loan statement for our owner-occupied debt, loan statements for our investment debt, then again, that will save us time and money because the accountant doesn't have to work through and separate those two things out. So there's some of the things we can consider when we look to acquire an investment property, take out a loan for acquiring an investment property. And I'm sure if you sit down with your finance person, explain your particular circumstance, your scenario, you can work through some of those, and perhaps there might even be some more that are worth considering that will help you out as a property investor. Okay, so I hope you found this information on how to finance an investment property purchase helpful. And look, if you haven't already and you feel happy to, please feel free to subscribe to my channel. That way you'll get notified when I upload new content. And if you're happy to like the video as well, that will give me a better understanding of the type of content people are looking to view. So thank you again for sparing the time to watch this video, and all the best with your journey.